I have the pleasure to introduce someone who most of you know very well for many reasons. First, Georges Dionne presented a webinar for 3 years, when I could remember. And secondly, Georges has been probably the professor of some of you. And third, because those who are working with the board of SCOR Canada are probably very familiar with Georges and Dionne and his views on risk. Professor Georges Dionne is the full professor at the Department of Finance within HEC Montréal. He holds the Canada Research Chair in Risk Management and is member of the board of SCOR Canada, as I said. Georges Dionne got a lot of awards, very, very well known, and especially, Leslie, for his book and Handbook of Insurance, and award from the Bank of Canada. He's also honorary PhD by the University of Orléans. He's teaching in Paris in the university. So I will not probably list all the title and the famous awards which were awarded to Georges Dionne. Let me just mention that beyond that, he is currently leading the research project on the effects of inflation on insurers' performance and value, funded by the SCOR Foundation. And of course, maybe some of you, and they told me just after the peak of the inflation in 2022, beginning of 2023, probably inflation is behind us, as you are experiencing today. Not quite sure inflation is behind us, and therefore the topic of the research is not only a very important topic, but a very hot topic currently. But the webinar will today investigate the cause of the gap in mergers and acquisition between life and non-life insurers in the US from 1990 to 2022. And one point which Professor Georges Dionne wants to highlight is the role of the monetary policy and especially of the Federal Reserve. I will leave the floor to Georges Dionne, Professor Georges Dionne, but before that I would like to thank him so much to have accepted to present his webinar. And I remind you that it is a maximum 1.5 hour webinar. We have first a presentation by Professor Georges Dionne, and thereafter a Q&A session. And when there are no more questions, we close the webinar. Just let me remind you the rules. Only technical questions are accepted during the presentation, no discussion, and the discussions begin, and the question, and especially the challenging questions, have to be asked after the presentation. Professor Georges Dionne, thank you so much, and you have now the floor.
Thank you very much. Good afternoon to everybody. This project is a curious project because when we started this research, we observed a big difference in merger and acquisition between two sectors in the US. And at the beginning, we were thinking it was because of climate risk events. We did study climate risk events for many months. And at the end, as we will see in the presentation, we did reject climate risk as a causal factor for these differences. So we start to study life insurance market and observe that probably this is the monetary policy that is the causal factor of the variation in merger and acquisition in the United States. Since many of these insurance companies are clients of SCOR, so it is still important for SCOR to know this result. Sorry, I will have to load again.
It does not function, you think?
It does not. It does not
move. If it does not move, maybe I could, in the mean, if there is a problem, I will share the document, and then you therefore don't be afraid. Try again.
I will try again. Yes.
Yes, try again. We are sorry. We had since the beginning. We don't know why a small problem for sharing the document. And just apologize. And in any case, if there is a problem, I will share myself the document and how to say, take over for sharing the presentation and leaving only Professor Georges Dionne present explanation. Professor Georges Dionne, do you want me to share the document? Oh, good. Okay, let us see. Yes, it moves. Okay, it's fine. But we don't hear you, Professor Georges Dionne.
Now?
It's okay.
Yeah,
we hear you.
Okay, sorry. So the objective of the study is to identify the main factors of the insurance industry consolidation, okay, during the recent years. We examine our market difficulties in the annuity of life insurance companies related to low interest rate can be a causal factor for this problem. Other potential causality or co-fundant factors are also analyzed. And to establish the causality link, we use the difference and difference methodology. I will explain a little bit what is this methodology later on. Now you will have to, it does not work, I don't know why. Sorry.
You can forward the page in the bottom left-hand corner. There you go.
Yes, you have stopped
Păi
to
se
share.
pasa, we turn on the presentation.
Do you want me?
Maybe, yeah.
Do you mind me, Professor, that I share the document? And then
yes, better.
When you want to change the slide, I move the slide forward. Let us try. I do it. And you just say to me which slide I should present.
Okay.
Do you see the slide currently?
Okay, you can go. Yes.
Okay. It's good?
Not en plan écran.
Yes, I will
Plan
put it.
screen. Yeah.
Yeah. Okay, I just not sure I am able. Okay, it's good?
Yeah, it's good. It's okay.
Okay, you can go. Next one, please.
Yes.
Yes. So there are many difficulties to isolating the good causal factor when we do this type of analysis. And because there are many alternatives that can explain capital consolidation in the insurance industry. Back, please. Okay. So the second difficulty is to identify other potential events. Okay. And during our period of analysis, we had the financial crisis, okay, and we also had many climate risk events in the US after 2012. After the financial crisis, we also observe many new regulations in the insurance sector in the US, in the life insurance sector, and also in the non-life insurance sector. So we don't think that these changes of regulation are important to explain the difference between the two sectors, because the change in regulation in each sector was about the same. Next, please. So this is what we want to explain. Line represent the number of merger and acquisitions in the P&C sector and health sector. I will call this non-life sector. And in this blue line, this is the number of merger and acquisitions in the life sector. What do we observe? We observe that the numbers are about the same until 2009. No statistical difference, as we will see. Then there was a little jump in life for 2 years, 3 years. And after that, life decreased a lot. We also observed that the non-life sector was quite stable. And this is why, as we will see, that we didn't suspect at the end that climate risk events should be the cause of the difference between the two, because the numbers of merger and acquisition didn't change very much after 2012, but it went down after 2012. So this type of graphical representation is a good candidate for a causal analysis. Why? Because we observe a kind of parallel trend before the event, 2012, okay, and a big difference after. So if we are able to identify the event in 2012 that caused this difference, then we are able to say with this methodology that the Fed is not only correlated with the difference in merger and acquisition, but is probably the Fed monetary policy a causal factor. Next, please. So we did study between 1990 and 2012 our targets in the US market in the three main lines of insurance: life insurance, health insurance, and P&C. During that period, there were 3,366 merger and acquisition. This means 3,366 targets, okay? And during the period. In the next figure, we observe, we can go, we observe, yes, the evolution of merger and acquisition in the US during the period of analysis, okay? What do we observe? We observe a big increase until this recession, okay? The 2000 recession, okay? And after 2000, there was a big drop in our lines of insurance, okay? Then after the recession, it started to re-increase until the financial crisis. During the financial crisis, particularly in 2009, okay, in the middle, where Lehman went bankruptcy, the numbers were very low for all, and then it started to increase, and then in 2012, we had a big drop. And we have to identify in which sector we had this drop. Is it in all sectors, in some sectors, and why? The next, please. The next, please. Here we have the evolutions of merger and acquisition in the three main sectors of insurance in the US. Again, this line is for life insurance. And again, we observe that that in 2012, we have a big drop and it remained. Okay. The green line is for health insurance, and this blue, the other blue line is for P&C. So to start the analysis with a simple model, because of this representation, we decided to merge merging and acquisition in health insurance and in P&C. And this merging was considered as the control group in the analysis. And life insurance was considered as the target group in the experimental study. Again, we observed difference, major difference in 2012. So we will treat these two groups as one group, and it will be the control group. Next, please. What is difference and difference for those who do not know? This is quite recent in economics. It was used a lot in science, and the main contributors of this approach in economics received the Nobel Prize in 2021. Okay, so now it is difficult to say that this is a causal factor if we don't use an appropriate methodology. A simple regression with a significant parameter cannot be claimed as to be a causal factor, because we can have easily, particularly if it is a linear regression, that we can easily have a reverse causality. Okay, for example, we can say that firms that do risk management have higher value from a regression, but we can also say from the same regression that firms with higher value do more risk management. So we cannot conclude on causality. Okay. So this is a methodology, difference and difference, that help to find a causality link between events and consequences. Okay. Usually, an event is exogenous, okay, like a change in law. Okay, for example, a very important example is the change in law in California, where they decided to increase the age for smoking from 18 to 21. Okay, so California was considered as the treatment state, and other states without change in law were considered as control state. Here, this is a little bit more complicated because there was no change in law. There was change in monetary policy, but this is not fixed as a change in law. A change in law, we have a very precise date for the application of the law. Here, as we will see, they change the monetary policy usually each 2 or 3 weeks. So this is difficult to find the exact date. Usually in difference and difference analysis, we have an experimental or target group. For us, this will be the life insurance sector, and we will have a control group. At the beginning, we will consider P&C and health insurance sectors as the control group, but after we will consider them as 2 different control groups with more recent articles, methodologies. Next, please. So the main research question is the following when we do a difference and difference analysis. Are the experimental and control group affected differently by an event when they were similar before? So there are 2 conditions. We need a big difference after the event, and we need to prove that the 2 groups were similar before. Okay, we call this the parallel trend analysis. Okay, if we cannot show they were similar before, we cannot conclude that the experiment was a causal factor. And of course, is the difference after the event is not statistically significant, we cannot conclude that there is a causal factor. So, as I already said, merger and acquisition in life sector were differently affected than in the P&C following a shock in the US monetary policy. Is this event a causal factor? Next, please. So again, this is the same graphical representation, but just to be more precise, we observe a kind of parallel trend before 2012, with a small exception here in 2009. Okay. So we have 2 dates, 2 different dates. And this is why this is difficult when this is endogenous. We have to fix the true date of the event. So we will do statistical tests to isolate, is it 2009 or 2012, the treatment date. And then after, when we conclude, suppose we conclude that this is 2012, we will analyze these two distributions before 2012 to see if we do not reject a parallel trend, okay? And if we do not reject a parallel trend, then we will analyze with a regression analysis if 2012 is a causal factor for this difference after the event date. Next, please. So we start with usual statistical test, okay? And the three tests, student test analysis, median test analysis, and Wilcoxon test analysis, did not permit us to conclude. As you can see, the difference here is statistically different using a T, but this is also statistically significant for 2012. So we cannot discriminate between 2009 and 2012. The same is, conclusion is the same for the median test, and this is a p-value. And again, the difference in the p-value are not enough strong to conclude that 2012 is the date instead of 2009. And again, for the Wilcoxon test, we cannot conclude. So we had to use more recent tests proposed in the literature. Next, please. So the two tests are the monotonicity hypothesis and the median criteria test. This one was proposed in 1994 in studies not related to economics, but in social science in general and in health studies. And one of the co-authors of this test is Imbens, who was one of the 3 Nobel Prizes in 2021 for causality analysis. The second test was proposed by another researcher, Guest, and it was published in Journal of Finance in 2021. Okay. So I will explain the two tests with the next figure. So again, we have our two distribution of merger and acquisition, and the green histogram is the difference between the two. And it is the difference between the number of events in life and the number of events in non-life. So as you can see, because of the difference here, those numbers are all negative after 2012. 2 of them are positive after 2009. And the test, the first test, okay, the monotonicity test, says that if there is a difference between an event, the sign of this difference must not change. So we observe that after 2012, our numbers are negative. There was no change. After 2009, we had 2 positive and many negative numbers. So we did reject 2009 with this monotonicity test. For the second test, in Journal of Finance, the test is to verify if the difference after an event date is lower than the median over all the period. The median over all the period is -2. Okay? And we can observe again that after 2012, all differences are below -2. But again, 2 of them were positive after 2009. So again, we did reject 2009. So we conclude that 2012 is the event date for our analysis. Next, please. So now we have to verify if there is a parallel trend in the data before 2013. Okay, so we include 2012 in that period. Okay, for doing that, okay, we use data to have enough observation because we cannot use only annual data. We have few observations. So what we decided is to use the number of acquisitions in each sector, each year, and in each state in the US. We know that insurance regulation is by state in the US. So many insurance companies have their head office in a state. So, and there are very few, there are some, but few insurance companies that have activity in each state, okay? So we decided to do the analysis by state, okay? And what we did is to construct 33 dummies variables, one for each year, before and after the event, from 1990 to 2022. And we constructed a time dummy variable to isolate the effect of time on the merger and acquisition in the two sectors. The objective is to see that there is no difference before 2013 and a big difference after. So if we go to the next slide, we did 2 tests. We did the standard parallel trend analysis. And as you observe, for each of these dummies, very few are significant before 2013. Okay, if you go on the other slide, please. With few exceptions. So if we do a global F test, we will observe that there is no statistical difference between the two groups, live and non-live, before 2013. We did also, the previous one, please. He did also this new test, okay? This new test proposed in Review of Economic Studies 2 years ago. And again, this new test is gave about the same results. Next, please.
Okay, next.
Yes,
Next.
that's
Yeah,
okay. So, no, sorry. So what we observe, the main difference is that here we have a constant in the analysis. In this paper, they suggest not having a constant because of the F test and to choose 1 year as a kind of constant. Again, we observe that after 2012, all years are statistically significant, okay? Meaning that there is a big difference between the P&C group and the non-P&C group. We have the same results with the new test. So we can conclude that there was a parallel trend before 2013. So we can apply the difference and difference analysis. The next, please. So this is the main regression that we use in difference and difference, okay? Here is the number of acquisitions in a given state for a given year, okay? So we have the merger and acquisition in the life and the merger and acquisition in the non-life. We have a constant and we have our variable. Our variable here is treated. Treated is a dummy variable having the value 1 for life and 0 for non-life. And there is an interaction with time post 2012. And we want to observe that this coefficient is significant. If delta is significant, this means that there is a difference in merger and acquisition between the two sectors after 2012, okay? We don't, in this type of analysis, we don't use control variables. We can, but this is not necessary. We will see later what does it mean. But we have a fixed effect for each state. So this variable is equal to 1 for a given state and 0 for the other state. And we have a time fixed effects and a random effect. Next, please. So what do we observe with this simple model? With this simple model that was estimated with panel data methodologies, okay? So we have, again, state fixed effects, year fixed effects, and we have, when we compute the standard error, we use clustering for the states and clustering for the years, okay? And what we observe is that our basic coefficient, delta, is negative and statistically significant. This means that there is a big difference in merger and acquisitions after 2012 between the two sectors. So in this type of analysis, we can have what we call confoundants, okay? We can have other factors that may have affected our coefficients, okay? As I said at the beginning, we did analyze many, but the main factor here is climate risk events. Do climate risk events affect this coefficient, or are they independent of this effect? What do we observe is that the number of climate risk events in each state, each year, okay? And the data is from Verisk. And an event from Verisk is an event with more than 25 million loss for insurance companies in each state, okay? 25 million. This is not very big, but they don't compute data for lower event. And we observe that the number of events each year does not affect our coefficient. It is very stable. If we use the the losses instead of the event, again, the coefficient itself is not significant, and our coefficient does not change. So this is a basic analysis of cofundants, okay, or control variables. And more recently, a new methodology was proposed following new models on difference and difference. And we did apply this methodology as we see in the next table. So here we have a two-step of analysis. Okay, we have a two-step of analysis because those are dynamic data. Okay, so there can be some correlation between the merger and acquisition events and climate risk event that are not well taken into account with in the previous slide. So in this new methodology, what they suggest is to do a regression analysis, not a difference and difference analysis, only a basic linear regression model when we have the number of events on the number of acquisition only in the control group, okay? And we did that, and in fact, in the P&C sectors, the number of events did affect positively the number of merger and acquisitions. So there is a kind of correlation. The losses are not significant. Okay, the losses in billion or in log 1 plus billions are not significant, but this one is significant. So what the methodology suggests is to use these results to construct a new dependent variable for the difference and difference analysis while we subtract these potential effects. Okay, we have to be careful. We subtract the effect, but the variable that we will use are not the residuals, because there are still the fixed effects for the states and the fixed effects for time in the data. When we do that, we do the difference and difference analysis again, and as we observe, there is no difference in our coefficients. So even if we use the new methodology, our results are not affected by the presence of control variables like the number of climate risk events or the losses in climate risk events. Okay. Then we did study new methodologies for difference and difference. Next slide, please. The next. So what we did up to now was to consider, okay, the P&C and the health sector as one group. But these two groups can be different, particularly here, okay, particularly here. So, we may consider them as two control groups instead of one aggregated, okay? And this is what it is suggested now in the new literature on difference and difference. So we will have a target group, life insurance, and we will have two control groups, life and P&C. Next, please. So here, this is not very important. What we do is, what happens if we use the two new methods with only one group? The coefficients are different, but they remain statistically significant. The main result is here. So the first alternative to difference and difference is synthetic control. So synthetic control was proposed in the literature at the beginning of the 2000s. And the model is as follows. Instead of having only one group, we keep the two groups, and even the model estimate the weight of each group. So we have two control groups with two different weights, and then we do the difference and difference analysis. Okay, this is this one. Synthetic difference and difference is very new. It was proposed in the American Economic Review in 2021. Okay, they make an extension of both. They make an extension of the difference and difference by using long panel. Here, this method was more for short panel. And more importantly, because we have long panel, instead of computing weights for each of the control group, we allow the model to compute different weights for each control group over time. So if we go back to the figure, here we observe that the difference is quite large here. It is different here. So the model will compute different weights, let's say for this period, and this period, instead of having only one weight for each group over all the periods. We can go up, please. Next. No, I'm sorry.
The former or seed one is
back, please.
That please. Okay, it's fine.
I'm sorry, back, please.
Back. Oh,
wait.
I thought that.
Okay.
That was. I
sorry.
misunderstood. I apologize.
So here we have the two models. We have difference and difference. And here we have two control groups. We have two control groups, but no weight, okay? No different weight for each control group because the model cannot compute it. There is a small difference, a very small difference, okay? Here, when we have different control groups and different weights, but the same weight over time for each group, this is statistically different, but not very much. And again, the new, more general methodology, okay, published in 2021 with different weights that move over time, but the difference between the coefficients is very, very small. Here we have a larger difference because we suspect that synthetic control is not a very good model for long panel data. Okay. This is good for very short panel. But with long panel, the two methodology with our data give exactly or about exactly the same results. So what do we conclude here? We can conclude that there was an event in 2012, okay? And this event can explain the difference between merger and acquisition after 2012. Because of the methodology, we can see that this is a causal factor. But what is the factor? What did happen in 2012 that may have introduced these differences? We did analyze the change in regulation. We did analyze climate risk events. And now we will analyze monetary policy. Next, please. The first question is that we analyze in 2022 is why climate risk cannot explain this difference. In fact, there was no big change in merger and acquisition in the P&C sector after 2012. Why? There were many climate risk events, but the capacity of the industry to take care of these events, at least until 2020, our data are until 2020. We are updating the data now, but this study was published in Risk Management and Insurance Review in 22. The capacity, what we show is that the capacity of the P&C insurance industry is enough to take care of these events. Why? Because they increase very much insurance premiums. There was a big increase in insurance premiums. And for the small insurance companies, they increase their co-insurance. And they increase mainly their reinsurance. Okay, so what I say co-insurance is participating in groups. Okay, and moreover, reinsurance, they did buy more reinsurance after 2012. So their capacity was about the same until 2020, which is after 2012. So we rule out definitely climate risk events. Now we start to focus on life insurance. We did study insurance coverage, life insurance coverage, the basic life insurance coverage. We did study the fixed annuity market that is under the responsibility of life insurers in the US. And we did also study the variable annuity market, which is again sold by the life insurance companies. The big difference here is, I know that variable annuity is not a very popular financial market activity in Europe, but it was very popular during these years in Japan and in the US. So what do we observe? The main difference is that in fixed annuity, they offer guarantee rate of interest, okay, and guarantee income over the years, okay, and usually those income are indexed. In variable annuity, this is more volatile, okay, because those who buy variable annuity can decide the content of their investment. They can buy share, they can buy bonds, okay, or other financial assets. So it follows the market. It follows the market. And one particular thing that is important is that life insurance companies were acting like risk manager with this product. They did guarantee a minimum return for those who did buy these products. This minimum return was a very big problem in Japan during the 20s because the stock market went down, and because of that guarantee, life insurance companies lose money. Okay. As we will see, it can be a causal factor for the US life insurance sector, as we will see in the next figure. Just to mention that usually the minimum return is 3%. Of course, if the bond rates are at 5, 6, even 10, this is not very costly to offer a minimum of 3. But as we will see, the interest rates were going very, very low after 2012. The next slide, please. So what we observe here is the Fed rate, the basic Fed rate, interest rate. And what we observe is the big monetary policy after the financial crisis. It started in 2009, in the middle of the financial crisis, when the 28, in fact, when Lehman went bankruptcy. There was a lack of liquidity in the markets. So the Fed decided to buy bonds, okay, to buy bonds, etc. And they did that 3 times over time, okay? And because it was not enough, okay, to reduce the interest rate. Okay? They did that to reduce the basic interest rate that was too high, according to the market. So the last one started in 2012, okay? And what we observed after 2012, the interest rates were very low, the Fed interest rate. Here we have the 10-year T-bond. 10-year T-bond are very important for life insurance companies. Why? Because they invest in these bonds. This is a kind of important asset. What do we observe is that the return on T-bonds became very low after 2012. Here we have 2%. This means that the income with these bonds after 2012, okay, was below 3% for many years. But at the same time, they had to provide 3% to their clients. Okay? So they were losing money with these bonds and with this guarantee, meaning that the monetary policy that reduced the 10-year T-bond significantly, okay, reduced very much one big sources of income, the variable annuity market, okay, with returns lower than 3%. At the same time, the life insurance company had to pay 3% because of their commitment with their risk management tool. Okay. So what did happen in the market? Next, please. So low interest rate reduce the benefit of variable annuities and reduce the demand for annuities. After 2012, the 10-year interest was below 3%, a guarantee often observed in variable annuity market. So it became very costly for life insurance to offer this guarantee. And what were the effects? Because they were thinking, I think, that it was for a short period. Okay, so they didn't really change their risk management. Okay, so we observe after 2012 big reduction in stock returns for life insurers, increase in management fees for variables annuity, particularly for this risk management tool, and reduction in sales. Many insurers stopped to offer this product. Others left the market. Next, please. So what do we observe? Here we did a regression analysis, okay, on the premium, the net premium written between 2000 and 2018 from the sources in NAIC. Okay. It is difficult to have data on the two markets now. There is a kind of aggregation, so we were not able to go to 2020, but this is enough. What do we observe? We observe that this interaction variable post 2012 times Fed interest rate, okay, is highly significant to explain the reduction in sales of variable annuities after 2012. The effect was not significant for fixed annuities, okay? So this means that this is probably that risk management tool that was a problem. So the sales went down. Next, please. Here is the combined ratio. You certainly know what it is, the combined ratio. I will not go into detail, but again, we observe this is life, okay, until 2022. We observe after 2012, a big increase in the combined ratio in the life insurance industries. This means that profitability was going down significantly in the life insurance industry. Next, please. And this is what we observe with the econometric model, okay? Again, the post-2012 Fed interest rate variable is highly significant to explain the increase in the combined ratio after 2012. It was also significant for the fixed annuity. Next, please. This one is not important. Next, please. Here we observe the profitability, the net gain from operation in the life annuity market. Again, we observe that post 2012 Fed interest rate variable is very significant with a very big parameter in the variable annuity market, and even significant in the fixed annuity, but the parameter is much lower. Next, please. So we can go to the next one. So we did other, yes,
This
please.
one?
So,
Yes. Okay.
yes, so we did additional regression to conclude. So here we analyze directly the effect of the Fed interest rate, okay, on merger and acquisition directly, okay, instead of doing the methodology of difference and difference, okay. So again, we observe that there is a negative and significant coefficient, and this coefficient is not highly different than the coefficient we had in the difference and difference analysis. It was minus 0.689. Here this is minus, so this is lower, but this is still significant. However, if we have a study that do only this regression, they cannot conclude on causality because they did not make the difference and difference analysis before. Okay. Here, we can conclude that this is a causal factor because this variable changed with the event of 2012 related to the monetary policy. Next, please. So the slide before is for only in life insurance market. Here, this is in both market. So this regression is more like a difference and difference regression, okay? Because this effect, this coefficient measure the effect of 2012 on the difference in merger and acquisition between life and non-life. And again, it reduces the life. It is significant to explain the difference, okay? The coefficient is negative, meaning that life insurance merger and acquisition were much lower in the life sector than in the non-life sector. Next, please. So it is important to say that this is not only the targets, okay, the target insurance company that were affected, okay? It were the targets and the potential acquirers in the market, okay? So here, this graphical representation is for the merger and acquisition between life insurer and life insurer, okay? So here the acquirers are life insurance companies in the US. Targets are life insurance companies in the US, okay? In the previous graph, in the presentation, the acquirer could have been from other sectors. It can be a bank, it can be a non-life insurer, it can be an international insurance company, an international bank, anyone. But here the acquirer are only life insurers. And we did this graph because it is important to understand that the event of 2012 did affect mostly all insurance companies, life insurance companies in the US. So the potential acquirer lose money and didn't have money to buy a new insurance company. Targets were not interesting because they were losing money. Okay. So what we observe we observed that in the market, the activity were up to 35 acquisitions during these years. Okay. Here it was at 28, here above 20. And what do we observe is that after 2012, the number of acquisitions of life insurance companies by life insurance companies in the US were below 10 for almost all these years. So the market was affected on both sides. This is a kind of, not very strong, but this is a kind of equilibrium analysis. Okay? This is not a target phenomenon. This is an industry phenomenon. And the number of merger and acquisition drop a lot because acquirers and targets didn't have money to do merger and acquisition after 2012. Next, please. To conclude, we analyze the evolution of merger and acquisition in the US insurance industry. We show that different shocks may explain the loss of parallel trend in merger and acquisition between life and non-life after 2012. Because before 2012, the two sectors were mainly the same. We document that the difference cannot be explained by climate risk events. And we did also verify that it cannot explain by change in regulation and not by change in life expectancy. We know that life expectancy can affect life insurance business, but it had no effect. In fact, there was not really a change in life expectancy during this period. A significant drop in merger and acquisition was observed after 2012, and this drop is mainly explained in the variable annuity business. This is probably due, we are still prudent, this is probably due to a significant drop in interest rate that increased the cost of risk management of variable annuities, because the insurance company did offer a minimum return of 3%, and they didn't really change that policy after 2012 because they were thinking it should have been a small period. So I conclude that life insurers did not adequately manage the interest rate during this period. Okay, they didn't change the product. Okay, and they didn't make any other risk management policy to take care of low interest rates that were low for a long period after 2012. A question, we can say that this is because of life insurance miss risk management. But the other question is, should the Fed consider this type of externality in managing monetary policy? Okay. Do the Fed takes into account the externality it introduced in different markets when they set the monetary policy for inflation, for example? Each time I did present this conclusion, usually people say no, the Fed does not have to take this thing because first, this is a pecuniary externality, okay? And insurance companies have simply to better manage their risk instead of waiting for the Fed monetary policy. Thank you.
Sorry, I will have just to exit. Okay. Okay, it's fine. Thank you so much, Professor Georges Dionne. It was very interesting and stimulating, in fact. And of course, it points the role of monetary policy when looking at insurance. But what is interesting, in fact, but it's a kind of byproduct of your analysis, and even if it is not as well pointed as what you have been pointing on life insurance, is the fact that we have the non-life insurance industry is not so much affected and not as much affected by monetary policy, which is exactly what we experienced, including in reinsurance.
Yes. Yes, and this is why there was no effect on the non-life insurance sector.
And but I have one problem. You say it's something which is strange in your demonstration. Let me just is that you are pointing the combination of Fed interest rate and specific variable post 2012, because
Yes.
if the monetary policy is influencing merger and acquisition, why does not monetary policy influence it in a continuous manner? That is, of course, the lower the interest rates, the less, of course, you have merger and acquisition, and the higher, the more you have. And why to have such a break in 2012? Is it just because of the level of interest rate, because they were around 0% and it is the 0% rule? The presence of this variable may be surprising, and why it would not have been sufficient to have the variable Fed interest rates into the equation.
No, this is not only the level, okay?
Mm.
This is not only the level. This is a combination on the level and the risk management tool used by life insurance companies, okay? Life insurance companies did offer a minimum return on variable annuities of 3%, but their main income was below 3% after 2012 with bonds. So this means that after 2012, they receive on average return on bonds lower than 3%, and they did offer a guarantee to their clients of 3%. So they lose money with bonds.
I am just looking if there are questions. Please don't
Now
hesitate.
go to the figure. Go to the
Okay.
figure, page 25.
Yes, I have to go to the. Sorry. You were just 25. You say.
Yes.
It's okay.
I don't see the
Non, on
figure.
voit pas.
Yeah. Sorry, I am. You don't see it.
Non,
No. And no.
non.
Not yet. Okay. I stop and I try again. If you agree, just let me. Just let me. Sorry, I'm just trying. Do you see it?
Yes.
Okay, it's fine.
This one. So the main point is that here we have a level of interest rate of 3%. Okay.
Yeah.
We observe that before (2010), okay, the average income from a 10-year T-bond is higher than 3%. And after 2012, it is lower than 3%. So the insurance company that use this investment, okay, and they use a lot 10-year T-bond in the US, after 2012, on average, for these new bonds, they receive an income lower than 3% on average. However, with their risk management policy, they had to pay 3% as income, minimum income, to their clients. So they lose money during that period.
So what you are insisting on is that the crossing of the line is not something which is a continuous phenomenon, because before crossing the line of 3%, they remain, even if marginally, profitable, and then thereafter, after having crossed the line, they are non-profitable.
They are not.
Okay, and then it's a Diracian variable by definition. Okay.
Until 2010, they were still profitable. The profits was low, but
Yes.
it was. But after 2012, okay, here you are 2%.
No,
And
I agree.
each year,
yes,
this is below.
I see your point. No. Of course, you were insisting on the point, but for me, at first, the minimum guarantee was something more qualitative, and what you say is really a frontier, a line that is crossed between profitability and non-profitability, and therefore is by definition a variable that is 0 before you are profitable and 1 thereafter you are non-profitable. I see the point. So, very important.
So the point is not the level of interest rate.
Yes.
This is a combination of the level of interest rate and the risk management policy of those life insurance companies.
Okay.
So here, if we offer 3% as minimum return, there is no loss. Okay. Yeah. This is like offering a put out of money. Yes, but here exactly. they are in money.
Yes, that is before the 3%. Of course, the question of the M&A is to find the good price, because depending on if the profitability is higher or lower. But after the 3%, there is no more price because it's below 0.
Yeah.
Okay. No. Are there questions, please? We are, of course, time is going on, and we should in 2 minutes leave the webinar. I would like to insist, I know that we have learned a lot and a relatively technical presentation, but very pedagogical. Please let me know questions. Which just, if I may conclude on one point, Professor, is that the question of the minimum guarantee are key variables for a company by definition, and probably for also line of business, which could be applied also in non-life insurance, where you have sometimes some minimum guarantees, which of course not of financial or monetary nature, but which could play the same role in case of.
I can answer the first part. The first part, it was very popular in life, and it is still. Okay?
It is still, yes, also in France.
Okay, now, when I look at that, I think AXA was offering that, but I don't know how big is the market for this risk management tool in life. In non-life, I cannot tell you.
Yes, of course.
I did not study in non-life with this, but since you already said that interest rate is not a particular important risk for non-life, I really don't know. But they do not have to offer this to their clients in non-life because
of course
the claims they receive are not related to the interest rates.
No.
In life, this is related to interest rates in variable market.
What you could have in non-life if bottom guarantees not linked, of course, to interest rates or monetary policy, but that may be activated in different circumstances, as we saw, for example, during the pandemics.
Yeah, we need a dynamic risk management policy instead of a fixed one. Mm-hmm. And the other mistake, like in Japan, okay, because it was new, they anticipated that this effect will be a short-run effect, and they didn't change the options.
Yes,
but they should have changed the options.
Okay.
We have the same thing with inflation.
Yes, exactly.
It's not clear that life insurer and non-life insurers anticipate well inflation.
And it's a current challenge.
Yeah.
Because, of course, and relatively difficult to manage. I think most of the people who are connected today are probably fully aware of that. But I think here we are past 4 o'clock Paris time. I think we should now close the webinar. And firstly, I would like Professor Georges Dionne to thank you very, very much. It was a very insightful, very stimulating presentation. And of course, you are leaving us with a lot of question and challenge we have to look at, even in the reinsurance industry. Maybe not exactly the same for the life insurance, but we have to learn from what happened to the life insurance companies.
Thank you.
Especially in terms of risk management. So I would like to
see you, Philippe. We can't see you.
I don't know why the camera has been closed automatically. It does not. Oh, sorry. It says to me that I have to change something, and therefore you will not see me. I just apologize. There is a problem with the functioning of my camera currently. So thank you so much, Professor Georges Dionne. I see there are no other questions, and we will now close this very, very stimulating webinar.
Thank you.
Goodbye. Sorry,
Bye.
And I apologize not being able to reconnect my camera, but I hope you have some indulgence. Goodbye.
Thank you. Bye-bye.
Thank you.
Bye.
Bye-bye.